This is LXBN TV, and I'm Colin O'Keefe. Joining me today to discuss the recent Libor scandal is Stephen Berk, attorney with Berk Law in Washington, D.C., and author of the Corporate Observer. Stephen, first off, what is Libor, and what does this scandal entail?
Well, good afternoon, Colin. Okay, so LIBOR means the London Interbank Offered Rate, and it's basically what's considered a benchmark interest rate, and it's an industry insider sort of benchmark in that it's the rate that banks charge other banks for lending. So behind the scenes, while we're all fast asleep, the banks are lending each other money so that they can keep capital moving around the markets. And the way they set the LIBOR rate is they effectively fill out a survey that says, kind of what their needs are, what capital they have available, and, there's a lot of good faith between these guys in terms of setting that rate. And then what happens is once the rate is set, a lot of other interest rates are pegged off of that rate, meaning, if you have a business loan, it might be LIBOR plus 2%, or if you have a home mortgage, it might be LIBOR plus 4%. So the LIBOR rate is an important benchmark in the financial services market.
Mm-hmm. And with this scandal, and you wrote on this, who do you see as the biggest victims here? Who was harmed the most?
Yeah, it's really hard to say because, anyone who borrows money is harmed in some sense. So in some ways it's everyone. And let me see if I can explain that briefly for your viewers. What the banks were doing, instead of in good faith giving what their rate was of interest, what their how much they should be charging, they created a LIBOR rate that helped them when they were doing derivative trading. So it wasn't an honest LIBOR rate. It wasn't their honest interest rate. It was a rate that let them kind of, if you will, and I'm searching for the right word, but manipulate basically the markets. So they may have been taking a position somewhere in a trade and they needed the interest rate a little higher or they needed the interest rate a little lower, and so they played with the LIBOR rate. And that's that's a little bit of an oversimplification, but they weren't providing other banks nor were they providing the consumers with the true interest rate. So the folks that get hurt are anyone with a loan, anyone with a loan that's pegged off LIBOR. And interestingly, it may have gone the other way. So some people might be net winners, not net losers, which makes it even more complicated.
Mm-hmm.
I think the biggest group of losers or people that have been victims are the states and local governments, because what they do is they do a lot of interest rate swaps. They do a lot of hedging on the interest rate that they pay on their bonds.
Mm-hmm.
So they might have a bond at 6%, but they'll hedge that with what's called a derivative or an interest rate swap. And not to get too overly technical, but because the LIBOR rate had been manipulated, they basically were paying more interest than they needed to pay. And that's directly coming from what the banks were doing.
I see. And finally, do victims of this scandal, it's so broad and there's so many people, do they have any recourse? I saw some of the global firms on LXBN are starting to say they're putting task force together and that type of thing. But are we going to see a rash of lawsuits based on this? And do you think that they'll be successful?
Well, it's interesting. I was approached about a lawsuit involving LIBOR 2 or 3 years ago. So this has been no secret, and it's been out there for a while. Yeah, there's going to be plenty of lawsuits because we're talking about deep pockets, we're talking about banks, we're talking about conduct that is, incredibly risky and also something that banks shouldn't be doing. Just parenthetically, there's something called the Volcker Rule, the Paul Volcker Rule, where banks shouldn't be doing trading. And this scandal directly comes out of the banks being traders. And when banks become traders, they wear two hats, right? They wear a hat as a trader, which is how can we manipulate things so we can trade effectively. And then the other thing that they're doing is that they've got to set this rate that's supposed to be correct. So to sum up my answer, yes, we're going to see lots of lawsuits. I think that the state and local governments will have the strongest lawsuits because their claims are closely related to the wrongful conduct. There's what is called in the law a nexus between the wrongful conduct and the harm that they suffered. I think cases involving individuals with mortgages or home equity loans, while they may be able to make some argument that the Libor manipulation harmed them, I think those cases will be more difficult.
Very interesting. Yeah, I mean, I think this is a scandal that's almost hard to grasp, and I think it's led to a slightly lower level of attention and understanding. But it's a lot of bad things going on. It just was not good. Well,
Yeah, no, just and I hate to
no, go
belabor
ahead.
the point, Colin, but you know, it's another example of banks being overly aggressive in connection with their responsibilities. And you know, traditionally we saw banks as folks that lent money, and now we're seeing banks as traders. And as traders, they have an incentive to play with these interest rates, with these benchmark rates, which really everyone relies on. And so I think if anything, there's going to be regulatory changes, or there's going to be a lot of pressure on regulatory changes, not just in the U.S. but abroad, to keep banks out of these markets.
It's going to be interesting to see what the fallout is in the coming months, coming years, possibly as well. Well, once again,
So
that was Stephen Berk of Berk Law and the Corporate Observer. For more of his commentary on the scandal, be sure to visit thecorporateobserver.com. Truly an excellent publication, and of course, we have commentary on the scandal as well at lxbn.lexblog.com. Thanks, Stephen.
thank you.